And without any further ado, I will invite Paul.
Hi. First of all, great turnout. Thanks to Blair and FinTechTO and Joyce and everyone else who's helped out. This is a fantastic turnout. I was at Blair's less organized one a year ago as well, and it's great to see the community going strong and thriving like this. On his last words, I will say everything here is our story. No two stories are alike. This is how we did it. There is lots of general wisdom, I think, out there that startups are sharing that apply to most companies and are a great way to go ahead and build a company. But by no means is there a magic bullet. You got to find your own way. I certainly wouldn't do some of the things that we did along the way if we were to do it over again. But most, and we're here until now. So starting off, how many people know Financeit? Do you guys? Yeah, some people. Yeah, lots. Okay, good. So if you don't know what we do point of sale financing. So it's basically we do big ticket purchase financing. So the best example that everyone knows, you go to buy a car. You're in the dealership, you get a loan, right? And there might be, 6 months no payments, there might be low interest rates. So we partner with merchants to offer point of sale lending. We do vehicle, it's not our primary vertical, but we do some vehicle. Our primary vertical is in the home improvement space, right? So renovations, getting a loan when you're having work done in your house. We market to prime customers, so we're in the prime borrowing space primarily. We're trying to go out there and just kind of, there are a lot of negative implications with some companies with the promotions and everything else, backdated interest. We're not about that. We're about transparency. We're about, trying to look out for the consumer as well, who often does not end up, they don't always know it, but often there are costs that go down in the background that they're not aware of that are being charged to them. So everyone else comes out looking great. So we're trying. That's part of our brand is to try and bring some transparency to an industry that at times can be murky. Okay, so you guys inserted a picture. There I am. Okay, in the beginning, if there are any Silicon Valley fans in here, but in the beginning there was Community Lend. So our CEO Michael Garrity founded Community Lend in 2007, and what he was trying to do at the time was truly innovative, right? It was peer-to-peer lending in Canada in 2007, right? So I think there was Zopa in the UK, there was Prosper, maybe Lending Club was like a month old or something, but it was just beginning, and Michael saw that model and said, I want to do that in Canada. So it launched in 2010, and then we found out pretty soon that regulatory restrictions were going to make finding accredited investors, which was a requirement on the lending side, pretty difficult, right? This was a restriction that other countries didn't necessarily have, where it was being successful. So the business was really struggling to take off, and a business model was needed, right? So I'll stop you right now, and here's lesson number 1 of being in fintech, okay? There's gonna be regulatory oversight, and it's gonna cost you money to figure it out, right? So if you're doing something truly innovative, you better get used to operating in the gray zone, right? Because no one's ever done it before, and it's in the financial space. There's no one there to tell you how to do it, right? And I'm sitting next to someone from OSFI, so don't take it personally. I understand it's difficult and everything else, but definitely it is a challenging thing for a startup to have to deal with, costs of the legal costs. I'd say in most fintech, when you're doing an MVP, you will also need an MLP, right? So it's not just a minimum viable product that everyone in the startup world talks about, but a minimum legal product, right? What basis should you be covering to make sure you don't leave yourself too exposed, right? And lawyers at the beginning can be just as important as coders. And there can be some really hard choices here, because if you are doing something innovative, do you go and are you fully transparent with the regulators and say, hey guys, I have this great idea, I want you to tell me how to do this, and 5 years later and $2 million in legal fees, they might come back and say maybe or no, right? Or do you just do it and apologize later and maybe end up in jail, right? So there are some really tough decisions sometimes, depending on what you're looking to do. So it definitely adds a twist and a challenge in terms of doing kind of new things in fintech. So after Community Lend, there was a pivot, and Financeit came into play, right? So Michael, our CEO, realized that there was an opportunity in purchase financing or point-of-sale financing, which is what we do today. Casper, our third co-founder and CEO, was brought on board, as was I. I was contracting on the side. I was brought on full-time as a technical co-founder. And we landed in a $10 million initial lending pilot from ING. And 2 months of kind of dev work later, we took our P2P platform and added in okay, now there's a merchant as well, and then we had a purchase finance platform. It was great. It was fantastic. It was a thing of beauty. So Financeit.io launched in February of 2011. So early on, we saw some really positive signs of the new business model, right? So we signed up hundreds of merchants. We deployed that initial 10 million. There was a need in the market. I think we got lucky with timing in a certain way because in 2008, a lot of people who were playing in the space, HSBC, Wells Fargo, a lot of these big US financial institutions were doing purchase financing in Canada, and they all pulled out in 2008 because it wasn't core to their business and they had bigger things to worry about. So all these people that used to offer this were they didn't have it anymore. So we found that there was a void really quickly and started filling it. So we managed to hold it all together despite running a pretty ambitious business with lean resources and capital, right? I think that's a story for just about any startup once again. By the end of 2012, we'd already had $200 million in applications and 60 million funded, right? So at that point, it was great. We were feeling pretty good. And we decided, let's think bigger, right? So, you talk about communities like this, you talk about giving back to the community. For us, maybe not for you, but for us, there were two pivotal events in 2012 that propelled us to aim higher and think bigger. So the first was the C100. So if you're not familiar with the C100, they're very active in the startup community here in Canada. They help Canadian companies get access to US Valley VCs. They're based in San Francisco. They're all Canadian expats. They help you, right? And what they helped us do when we went down there is that we weren't thinking nearly big enough. They basically made us realize what US investors were looking for, and we were nowhere close to it. So we took that, and we thought bigger, and we went to Financeit, which I think is a pretty well-established conference now. It was pretty new at that point, first or second year. And Financeit helped us get a lot of exposure. So it's a great conference for early seed startups to get noticed, get attention. I definitely recommend that if you're trying to get on the radar as a fintech company, Financeit is a fantastic, well-run conference, and there's plenty of people get attention and interest there. So those things led us to, when we were at Financeit in 2012, we got introduced to FIS Global, who's kind of the world's largest fintech company. They power a lot of the core systems of a lot of the major banks around the world. So they invested in us. They led our Series A in 2013. They helped us launch a US beta in 2014 in the US market. So that was, sorry, I didn't mention that. When we were thinking bigger, we were we just went to Financeit and said, we're going to the US. FIS probably wouldn't have talked to us if we hadn't said, we're going to the US. We didn't really know how we were going to the US at that point, but we just said it, and people showed up. After the US launch, we attracted the interest of Goldman Sachs, and they led our Series B in 2015, late 2015. So when you look at it here, it looks like this great, wonderful progression. The reality, of course, within that progression is there was a whole lot of roller coastering going on, right? So a lot of ups, a lot of downs, but on the up and up, I think it was a very exciting progression that got us to where we are today. So lesson number 2, all the usual startup lessons apply in fintech, right? So everyone who talks about, paying attention to the customer, minimum viable product, all those things that apply to normal startups also apply to fintech, including one that really, I think, helped us for where we wanted to go, and that's lesson number 2, which is think big if you want to be big, right? So, like I said, the C100 made us realize we weren't thinking big. So we told the world we were going to be big, and hey, it just kind of fell into place by people responding to that, being excited by the product they saw we had in Canada. And it ended up being very good for us because, in fintech, reputation and credibility matter a lot, right? So when someone's taking money from you, and in lending especially, and they want to repay money, they want to know who you are, right? Like who are you? And our merchants, they've seen people like Wells Fargo, HSBC pull out of the Canadian market in 2008. Why would they spend so much time partnering with us when we could disappear just as easily? Who are we? Who are we backed by? Those things really matter. So in a lot of fintech industries, your reputation is crucial, right? And the banks know that very well. So on the home front, 2016 has been a great year for us. We continued to onboard new kind of lending partners, and we've secured over $200 million in lending capital this year. Our primary focus is to be #1 in the home improvement and lending space in Canada. It's a big market, so a bonus lesson definitely is focus is important, right? This is one of those kind of generic startup. Everyone should in a startup should figure out exactly what you're going after, right? We had a lot of opportunities. We were doing massive vehicle at the beginning. That was our prime, where we were having the most traction. We wanted to go into retail. We could do travel. We could do health. We could do home improvement. So at the beginning, we were like, oh, every vertical you can possibly finance, we're going to finance. We just weren't building a product for a year or two that was tailored enough to satisfy any of them, right? So as soon as we said, hey, okay, it's home improvement, we really started getting to know that segment. All our builds were with them in mind primarily. And that's where we really started seeing massive year-over-year growth in that vertical and in the business overall. We have a great team, and we have a great product, and that has us well on our way to being #1 in the home improvement lending space. Let's see what else we got. So lesson number 3, and this is my last lesson, is scaling fintech could be hard, right? So scaling any company is hard. All the usual startup challenges apply once again. But, I'll speak to lending specifically because that's what I know. But, in lending you get bonus headaches, right? There's lots of bonus headaches. So if you can read that, I don't know, it's kind of small, but, you have to navigate new regulatory bodies with every expansion, right? So 50 states, hey, 50 regulatory bodies, right? And, sorry, what's that? Oh, minutes, okay. 50 regulatory bodies, and maybe you even have to do it at the city level, right? So, in Canada too, depending on what business you're in, you might have to deal with multiple regulatory bodies. Quebec is always its own special creature. The more you expand, the more overhead you have to deal with on the legal compliance side, right? It's expensive. It's necessary, but it's expensive. And if you partner with lenders, so in lending, right, you have 2 kind of different paths you can take in fintech. If you partner with lenders, it's unlikely you'll get to truly innovate, and you'll more be evolutionary, And I wouldn't say that Financeit is a particularly revolutionary company. We're not doing anything crazy new. We're being evolutionary. We're taking advantage of the absolute latest out there, which can be quite far ahead of what's in market at this point from everyone else, right? Because why is that? Because it's unlikely you'll find a financial institution that will back an unproven credit model, No, I mean, if you can find one, that's amazing. You found like a magical unicorn. But for a financial institution that's very conservative to say, okay, we're gonna like basically give everyone hundreds of millions of dollars based on their Facebook score. Like that's probably not something they're gonna want to do unless you've been like really proving it out in field, right? So like even in the early days when we were like, okay, we want to do e-signatures, it took us a year to get e-signatures approved. Because people didn't know how to interpret the OSCE regulations in that field. Now this was like 5 or 6 years ago. I think it's changed since then. But at the time, it was like, oh my God, you want to do e-signatures? I don't know what to do, right? So it can be frustrating at times. With lending partners, it's also a challenge to manage enterprise risk because it's always a risk the lending capital could disappear in the early days, right? So when you're bound to investors or lenders, if the market changes or some big fintech company goes down and they associate that with you, then it could disappear tomorrow, right? All that lending capital. The other way to do it is your own balance sheet, right? So you can lend with your own money, your own equity, your own capital, your own warehouse lines, your own lines of credit, whatever you have, right? So you have control of your own product, but then you have treasury and cash flow management issues, right? And if you grow too fast, like say, oh great, we're growing, this is incredible, sales is killing it, we're going to do 20 million in loans next month. Well, do you have $20 million on your balance sheet just sitting there waiting to go out? You might not, right? So if you grow too fast, you might go broke. There's credit risk as well. I mean, if you're the lender, you're going to bear the credit risk. And if you're truly innovating, you may be at the mercy of the regulators, right? Maybe you're doing something, and at one point the regulators will say, okay, no, well, we actually don't like that. We're not going to let you know, right? So, because you were in a gray area for a while, right? So other lending bonus headaches, quickly. Managing the tension between risk and growth is a tough balance, right? So with growth, you want to grow, but you don't want to lend to people you shouldn't be lending to, even though it's going to inflate your numbers, which is what your investors want to see, right? You have to think about the long-term risk. I think this has always been a challenge in lending, not just for startups, but even for banks and everyone else, right? But Lending Club recently had a scandal. They're a public online lender in the US. The founder, the ex-CEO was doing loans in his own name and his family's to kind of juice the books. So, it is a tension that you have to resist and that every startup's going to face. There's fraud in lending, and there's also, in lending, there's always macroeconomic forces, right, that can loom like an iceberg. So you go into a massive recession, everything could dry up, all your sources of capital and everything else. So, it's a tough industry, right? It is really tough to balance all that. So I'm being told I'm out of time, but I'm going to take 10 seconds. I think I own 10 seconds, right? Because just letting you know, Financeit, we're also hiring. You can go to our website. We got like 18 job posts open. I'm looking for devs also. If you're a dev, come see me after. We're great. I'm a nice guy. So, well, you got to trust me. But, I think that's about it. All right. Thank you very much.
We'll do like 2 questions. I'll do one question from the audience, and then I'll ask a question. One question, right there. You guys GCL.
So you mentioned that think bigger, right, as a Canadian fintech company. But would you say that if you didn't have that traction in Canada, you wouldn't have been able to grow and enter the US so easily?
Yeah, so again, you don't have to think big. I'm not advocating that you have to think big, but if you want to be big, you do have to think big. And I don't think we would have attracted the investors that we did, right, with the pedigree of, say, a Goldman or something else, unless we had thought at the level we would. If we just said we're going to be in Canada, you can absolutely raise money in Canada and do that, but I don't think you would have gotten kind of the big institutional backers that we did that are US-based. They don't, to be honest, a lot of the VCs, especially in the US, don't care too much about a Canadian-only product. Oh, sorry, the question was, hold on, it was if, without the traction, without thinking big, could we have done well in Canada? Right? That was it? Yes. Okay.
All right, one more.
What do you think the contribution of technology played in your success versus just having lenders give you money?
Okay, so the question is, what role did technology play? Again, I guess I am suited to answer that. So yeah, so I think. I don't think we could have built the company we have. So we own our own stack, right? Which is very unusual for a fintech company, especially a lending one. And we built it ourselves. And I don't think we could have built it at the speed we did without the whole modern day open source community to build things on that you see today. Now, it's very secure, obviously, but there's also a lot of building blocks that you can build it on. And I think, the future generations that are coming and are used to mobile and everything else, they expect a different user experience level than, go in the back of some room and doing a loan application back there. They're expecting transparency. They want to do it on their own phones. They want to see instant results. They want to be able to track things. I don't think you see that type of stuff. So I think while the whole lending and capital side of thing, I think could have been built by a lot of companies, I don't think we could have gone as far as we could have on the technology side without the latest modern technologies and stack, and we definitely wouldn't be the market leader that we are in the segment. So, yeah.
All right. If you have any more questions, you can swarm Paul later.